Good afternoon. It's 12 o'clock. My name is Jerisa, and I am part of the marketing team at Early Growth. I want to welcome all of our attendees to our How to Prepare Your Business for Tax Season webinar. And as you can see, this is my first time doing a webinar where you actually get to see myself and Anjum talking. So this is really exciting. I just want to remind everyone that if you registered today, this webinar will be available in the next 24 to 48 hours. You can find this video on our YouTube page. And we will also follow up with you with an email with a link to it. Also, if you are joining us today, I just want to remind you of our tax promotion. For anyone who signs up before December the 31st, you can get $500 off of your tax preparation. So don't miss that. We won't be having another discount like this again. So I encourage you to go ahead and sign up before the end of this month. If you have any questions during this webinar, just feel free to drop your question in the Q&A box, and we will answer that question at the end. So without further ado, I'm going to introduce our expert host, Anjum, who is the Chief Tax Officer at Early Growth. And Anjum, if you could just tell us a little bit more about what you do on a day-to-day.
Absolutely. Thank you, Teresa, and thank you everyone for attending. We hope you find this webinar useful. So my role here at Early Growth is I head our tax department, and a little bit about my background. I'm a certified public accountant with approximately 15 years of experience advising small to mid-sized businesses. Here at Early Growth, we work with approximately 1,000 venture capital-backed startups across the U.S. and in over 40 countries at this point, which exposes us to a lot of unique tax scenarios that startups face. So we hope that you get a lot of value out of this webinar, and let's get it started.
All right, let's get started. Perfect. So I'm going to just start right from the top. What is the biggest problem that you see with startups not being prepared for tax season?
Right. So if you can imagine, startup founders are incredibly busy with things like product development, fundraising, hiring a team, things like that. So typically what we see is taxes and accounting falls to the bottom of the totem pole if it's there at all initially. And what happens is tax season sneaks up on founders, and all of a sudden we're in January and you have a litany of tax deadlines that you're probably not aware of, but have critical consequences and a ton of risk exposure for your company. So the biggest issue we see with young startups is typically, in order to even get started on your annual tax filings, you need a good set of financial statements in place. And by financial statements, I mean an income statement and a balance sheet, which facilitates tax reporting. So if January rolls around and you have not even gotten started on your accounting for the year, you're already behind the 8 ball a little bit in that you need to get your annual accounting cleaned up for the entire year and in a hurry in order to get started on your tax filing. So the way I always explain it to startups is step 1, you need to get your accounting done for the year. And then step 2, you can get started on all the tax filings, which there are many of beginning in January of each year. So if you don't have a good accounting system in place, don't wait until January or Q1 of next year. Now is the time to get started on that. And that's one big hurdle that we see with startups each year is that they simply don't have their financials ready to start on tax returns. Another area where we see startups struggle a bit in terms of their tax reporting is the thing to keep in mind with taxes is there are many different levels of tax reporting. The most important tax filing are your federal tax filings with the IRS, but there are also state tax filings. In general, each state you have operations in, you're going to have some kind of state reporting requirement. So that's a completely separate filing. And again, if you have state activity in 10 states, most likely you're going to have state reporting requirements in those 10 states, which means 10 separate state tax returns. A really important metric to track there is your sales by state. So in general, if you have sales in California, New York, Illinois, you're going to have to carve out your sales per state for each of those state tax returns and report that revenue accordingly so that those states can get their share of tax revenue. So even if you do have a set of financials in place and you're tracking your revenue and expenses, that's a great start. But you need to take it a layer deeper and make sure that you're tracking your revenue by state, which is going to facilitate that state level tax reporting. Something else that is really important to do as a startup is to build out a tax calendar for your company. Like I just mentioned, there are federal tax deadlines, state tax deadlines, city tax deadlines, and a lot more tax deadlines that we can't go into in this webinar. But managing those deadlines is really important. If you miss a deadline, potential for heavy government penalties, which could delay things like fundraising or going out and raising venture debt. As part of due diligence, they're going to want to make sure that you're on top of your tax filings. So really important to get ahead of that by building out a tax calendar. And again, once January rolls around, those tax deadlines come really fast and frequently. So if you have that tax calendar built out at this time of year, you're well ahead of the game heading into January. Also, what we see with startups is a lot of basic information changes year to year. For example, you move to a new office, you change the name of your business. All of these things get updated on the annual tax reports. So it's important to communicate these issues to your tax preparer. Another area of taxation where we see startups fall a bit behind is payroll taxation with your employees. And even if you are working with a third-party payroll administrator, it's really important that you get that system set up properly and that you properly load your employees' information into that system. For example, if you have employees in multiple states, when you go to load your California employees into that payroll system, it's really important that you get that categorization correct. If you miscategorize a California employee as a New York employee, which is simple as clicking the wrong selection in the drop-down box, your California employee will have New York taxes withheld from their wages, and that's going to cause all types of downstream issues. So really important that you get your payroll module set up properly with your payroll provider to avoid those payroll tax issues. Another area where there's actually quite a bit of complexity for startups is even early on, we tend to see startups dip their toe outside the U.S. in terms of setting up a foreign subsidiary, hiring foreign contractors, which doesn't sound too complex, but if you look at it through the lens of tax reporting, it's extremely complex. There are a lot of really complex tax issues involved with non-U.S. operations, with non-U.S. contractors, non-U.S. employees. And the government is very strict on that area. If any misstep in your foreign disclosure tax reporting starts off with a minimum penalty of $25,000 US. So if you have foreign contractors, if you have a foreign subsidiary, if you have a foreign bank account, even really, really important that you supply that information to your tax accountant, and really important that you do it at the beginning of the year, because there are all types of deadlines around those disclosures, and any misstep in that area is going to cause you to incur a significant penalty. So that is one area that is really critical that you get correct. And lastly on this topic, we'll touch on this a bit more later on, but most startups qualify for what we call a research and development tax credit. And the one thing I wanted to point out up front is if you miss these tax deadlines that we've been chatting about, you potentially lose your R&D tax credit, which is a tax credit that the government gives startups up to $250,000 per year. So something simple like a tax deadline gets missed, you're jeopardizing an R&D tax credit of up to $250,000 for the year. So I wanted to point that out up front because it's really important.
Wow. Yeah, so there's a lot of ways things can go wrong. Thanks for pointing all those out. So a question I think that a lot of founders have is, do they actually need an expert to handle their taxes? Some people, think that maybe we can just do it ourselves. What are your thoughts on that?
Sure. There's absolutely a strong do-it-yourself culture in the startup ecosystem, which we certainly respect and admire. But when it comes to tax reporting, you can get yourself in a lot of trouble, and it's something that we see quite a bit of, especially with early stage companies that have a tight budget and they try to file their taxes on their own, initially at least. And that can have some real negative consequences. Even something as simple as missing a deadline, like we just noted, is potentially putting your startup at risk for significant penalties. Missing out on the research and development tax credit could cost you even a few $1,000s at the very early stages of your company. So we never advise that someone self-prepare their tax returns. It's just exposing or increasing your risk exposure as a company, which is already high as a startup. There are many risks in starting up a company. So you should be doing everything possible to minimize that risk and increase your risk. Working with a tax professional to minimize tax risk to your company.
And I just want to take a moment to remind everyone, if you have a question, just feel free to drop your question in the Q&A box, and we will get to that question at the end. So today is December the 10th. How can entrepreneurs get organized right now before the next tax season?
Absolutely. So as mentioned earlier, I think the number one thing you can do in terms of organizing your finances and getting ready for tax season would be to ensure that your company has a separate set of financial statements, meaning an income statement and balance sheet. You should have a separate corporate bank account for your company and run all business activity through that account, which would facilitate the accounting, which then in turn facilitates the actual tax reporting, is the main thing, Teresa. And what I'd add to that is, another important deadline is related to 1099 reporting for your contractors. That's coming up in January. And what we see a little bit of is, before you can even file your 1099s, you need some basic information from your contractors, their full legal name, mailing address, social security number, things like that. And if you think about it, if you have 10 contractors and you don't have this information, as simple as it sounds, if you come up to January and you don't have that basic information, trying to chase 10 people down for their social security number, address, things like that, it's going to take quite a bit of chasing potentially. And then all of a sudden you're running up against the 1099 filing deadline, and you're looking at penalties, you're looking at stress, and you're spinning your wheels on things that aren't important as a founder. Founders obviously are focused on product, sales, marketing, fundraising. Time spent on worrying about 1099 filings and collecting social security numbers is not a good use of time. So if you're collecting that information up front via Form W-9 now, you're going to save yourself a lot of heartache and potential penalties down the road.
Yeah, absolutely. So what accounting essentials should entrepreneurs adopt to stay organized throughout the year?
So a tool that we find very useful even for the earliest stage companies are basic accounting software. So something like QuickBooks Online is a great cloud-based tool that allows founders to very easily track their income and expenses at a minimum. Accounting can get complex, so certainly seeking out professional advice there is probably a good idea. But at a minimum, we like to see some sort of accounting software, some cloud-based solution in place, even at the very earliest stages. And also, like I mentioned earlier, if you have employees working with a third-party payroll administrator, is really important as well to make sure that you're on top of those payroll tax issues.
Nice. So you mentioned R&D credits, so I want to circle back to that conversation. Can you break down for people who are not familiar, what exactly is R&D credits? Like, what is the process? And why is it important to founders, or should be?
Sure. And this is my favorite part about the webinar, because there's some really true value to startups out there, and there's free money available to startups from the government. So the simple way to think about the R&D tax credit is it's available to any startup engaged in creating a new product, process, or technology, which is most of them. And in order to claim the credit, you have to do a little bit of homework. You have to have good record keeping. And generally what feeds into the amount of credit the government is going to give you is your annual R&D spend. The largest costs that roll into that R&D spend are, of course, the wages paid to your contractors and employees, your engineers, your scientists. those types of folks. So the government recognizes the benefits of research and development in terms of job creation, innovation, and all the downstream positive impacts it has on society. So in order to encourage founders and investors to take that risk and fund R&D initiatives, they put out an R&D tax credit. That credit has been around for many decades, but what's been really exciting in the startup world is approximately 3 to 4 years ago, the credit was tweaked to become more beneficial to startups. And simply stated, under this new version of the R&D tax credit, startups can claim a maximum tax credit of $250,000. So you, as a startup, if you qualify and you're keeping the proper records, you're literally getting a check in the mail from the government up to $250,000 per year, which is going to extend your runway, reduce your burn rate, and have tremendous positive impacts for your company. So really important as a startup that you are maximizing that credit each year, that you're doing things in advance to qualify for the maximum amount of credit available. And most importantly, that you're not missing any of those deadlines so that you jeopardize the R&D credit. Again, as a reminder, if you file your tax returns late, potentially your R&D credit is lost for the year, which is a horrible situation for a startup. So really important to have that general awareness of the credit and to get started on your taxes early, because in general, without getting too complex, the earlier you file your taxes, the more benefit you're going to get out of the R&D credit, and the quicker you're going to receive that credit amount.
Mm.
Some other thing, I'm sorry, Drew. So one other thing I did want to note is one big qualifier for the R&D credit is the U.S. The R&D spend needs to occur within the U.S. So your engineers, your contractors, need to be situated in the U.S. in order to qualify for the U.S. version of the R&D credit. That said, we do work with a lot of startups that tend to outsource their R&D offshore for very good reasons, to increase their runway, reduce cash burn. And there are other countries out there that have their own version of the R&D tax credit. So if you are one of those startups that has outsourced R&D, in the country that you do have your R&D folks, you should take a look and see if there are R&D credits from that country's government.
And how long does it usually take for the R&D credit process to happen?
There are a lot of hoops you have to jump through. But in general, if you get started on your tax filings early in January, you should start to see benefit from your R&D tax credit by Q2 of the year, of that same year.
Yeah, okay. So what if a startup is not generating revenue? Should they still file their taxes? And what happens when a few years go by without them filing?
Well, I'm smiling because we get this one a lot, and it's a very good question. But in general, once you form a corporation, Teresa, the IRS is going to require an annual corporate tax filing. So the short answer is yes. And often, like I mentioned earlier, startup founders are rightfully focused on more important things: fundraising, product development, building out a team, things like that, which makes perfect sense. So often we see them fall a little bit behind on their taxes. And typically what the trigger is for getting caught up is, they're looking at raising a new round of fundraising, and all of a sudden the investor, through due diligence, comes across the fact that the startup is a little bit behind on their taxes by anywhere from 1 to several years. And before the fundraising comes in, it's important that you get caught up on your taxes. So that's something that we see, something we can help you get cleaned up on. It's not as simple. I did want to point out, it's not as simple as filing back tax returns. Once you are late in tax filings, that's going to trigger some sort of notice, typically from the IRS or state taxing agencies. So even if you do get caught up on your tax filings and you get them in and all the back taxes paid, subsequently you're going to start to receive some scary notices from the IRS or state taxing agencies, questioning the filing, why it was late, assessing penalties, things like that. So if you do fall behind, just be aware there's a little bit more involved than simply filing the tax returns. There's going to be a little bit of cleanup with the taxing authorities to explain why you're late and potentially pay some penalties or get them abated if there's good cause for filing late. So It's a little messy to get in that situation, but rest assured, it's something that happens a lot with startups and something that can be cleaned up fairly painlessly most of the time.
Okay, perfect. And then we did touch on this, but let's talk a little bit more about payroll taxes and 1099s. How can founders stay compliant with their payroll taxes regarding their employees and contractors?
Mm-hmm. So when it comes to actual employees and managing all the due dates around payroll taxes, it's really important that you're working with a third-party payroll administrator and have an accountant oversee that process. So that's the easy way to stay on top of payroll taxes, all types of deadlines there. So really important that you're working with a professional. And when it comes to contractors, simple things like obtaining a Form W-9 up front, which is a basic form that the contractor fills out to provide their name, address, social security number, which will facilitate 1099 reporting down the road. So if you're working with multiple contractors that you have to issue a 1099 to at the beginning of each year, much better to collect that information up front as part of onboarding a new contractor versus scrambling in January to collect all that information from dozens to hundreds of contractors, depending on the size of your company. And also a unique area where there's a bit of exposure and risk for startups, a lot of them hire foreign contractors. So again, there's some IRS reporting around that, specifically Form W-8. Really important that you have your international contractors fill out that form up front, which is going to reduce your tax exposure down the road for your international contractors. Those international contractors are not required to be issued a 1099 for the most part, but there is some upfront paperwork that you should get from them to relieve your U.S. corporation from some potential outbound withholding taxes on those payments to foreign contractors. So those are the two main areas to be aware of when it comes to working with contractors, whether that's in the U.S. or abroad.
So what can entrepreneurs do before January 1st? Should they be making any last purchases, big purchases for deduction? Should they be looking at profit and loss, etc.?
Great question. And those are the types of discussions that happen a lot during this time of year. Generally, they pertain to startups a little bit further down the road that are turning a profit. And obviously, there are quite a few of those. So it's definitely a great time of year to sit down with a tax accountant, go through your financial statements for the year, determine what your rough profit is for the year, and discuss ways to legitimately minimize that tax exposure. And the number one thing that everyone tends to think of at this time of year is like, I'm going to go out and buy a heavy SUV and get a huge tax deduction for that to reduce my taxes. And that's true. That strategy can work if the car is for business purposes, of course. But the general advice we like to give our founders is that you generally don't want to purchase something purely for tax purposes because you're saving pennies on the dollar, right? So if you go out and spend $10,000, that might save you $3,000 in taxes. So if you really need that purchase, whether it's equipment or an automobile, obviously go ahead and purchase it and get that tax deduction. But if you're going out and purchasing, equipment or an automobile purely to save money on taxes, the math doesn't work out in your favor. So that's the general advice that we give founders is, it needs to be a legitimate business purpose and purchase in order to make overall financial sense. But some basic tax planning this time of year is taking a look at ways of deferring revenue legitimately and accelerating expenses. That's going to drive down your net income, which is the general measure for what type of income tax you're paying. Some other things to take a look at potentially are deferred compensation plans, 401k plans, defined benefit plans, things like that. And take a look at organizational structure. How are you structured? LLC versus S Corp versus C Corp, which we'll touch on in a little bit, is a really huge has a really huge impact on the amount of tax you're paying. So there are a lot of things you can do before year end to minimize your tax exposure. So sitting down with a tax accountant and having those discussions is really a good idea and a good utilization of time.
So when should a founder or company ask for an extension? And can we talk a little bit more about what those penalties look like?
Absolutely. So in terms of an extension for your income tax filings, we feel it's always best to make a protective extension filing early in the year. And again, as a founder, you're busy with important things like fundraising, product development, building out a team. Very easy for taxes to fall to the bottom of the totem pole. And if you have an extension in place, that's giving you extra time to file your taxes if needed. And there is no cost to filing that extension. The government does not frown upon companies that file extensions. They understand the real world issues they're dealing with, and they're happy to give an extension of time to file your income tax returns. That said, one important thing to note is an extension gives you extra time to file the tax returns, but it does not give you extra time to pay your taxes. So in general, your income taxes are always due April 15th, if not sooner, even if you do file an extension. So that the government is willing to wait for the paperwork, but they're never willing to wait for the actual tax due. So it's really important that you get the taxes paid by that due date, if not earlier.
Good to know. So yes, let's talk about choosing the right entity for your company. Why does this matter whether you choose an LLC, an S corp, or a C corp?
So this is actually a critical discussion to have up front with both your legal and tax advisors, and at the very earliest stages of your company, because it can have significant, massive impact down the road and potentially save you and your investors millions of dollars, or cost you and your investors millions of dollars. Really important discussion to have up front. So one example is considering an LLC, which is a very popular form of setting up your company because it's quick, easy, and cheap, versus a C corporation structure, which is a bit more cumbersome, a bit more complex, and costly to set up. But the LLC versus C corp discussion is something to consider up front, because if the circumstances fit, you want to consider that C corp structure, because there's a really terrific tax break that the government put in place called qualified small business stock that is only available to companies structured as a C corporation. So if you set up your LLC, things go well, and you have some sort of exit down the road, whether it's in the private market or public markets, you're going to pay capital gains tax on your gain, which is certainly a good position to be in. There's a lot of risk in setting up a company, and if you're fortunate enough to sell that company for a large gain down the road, that's terrific. But you're going to pay capital gains tax at that time as an LLC. Versus if you had set up your company as a C corporation initially, undertaking that little bit of extra cost and administrative burden, potentially up to, and I'm shortcutting this a bit, potentially up to $10 million of gain is completely tax-free at the federal level. So something as simple as setting up as a C corp versus LLC, it have a huge impact down the road in terms of taxation to the tune of millions of dollars. So really important that you work with professionals even up front at the very earliest stages to make sure you get that right. And also, if you're going out looking for institutional investors, they are typically going to mandate the C corp structure anyways. So depending on the facts and circumstances, again, most likely as a startup, it makes sense to set up as a C corp. But there are plenty of instances where LLCs or even an S corporation structure makes a lot of sense. It really just depends on the facts and circumstances, but critical discussion to have up front with professionals.
Yeah, absolutely. And then this I'm not as familiar with, but can you tell us more about the 83B? What should founders know about the 83B form?
Sure. So this is a very relevant topic in startup taxes, and 83B pertains to an IRS code section 83B. And all that pertains to is accelerating income into a current year when it comes to equity compensation versus letting that income accrue and get taxed as your stock vests. So if you're a founder and you have stock, you get a stock grant with vesting, 99 times out of 100, it's going to make sense to file an 83B election, which is a simple 10-minute exercise. There's some deadlines around that, so really important again that before you even sign that stock grant that you chat with a tax advisor. But in general, it's really as simple as You're picking up the value of your founding shares upfront in year one, when the value of that stock is generally very low, therefore the tax impact is almost zero, versus picking up taxable income as that stock vests and becomes more valuable over time. Generally, you're going to get a negative tax outcome that way. So most of the time with early stage founders and the stock grants that they receive, it makes sense to file that A3B election pretty early on. But again, that's a discussion to have with the tax advisor up front.
Awesome. And then can you tell us more about the 409A and equity compensation? How does that connect with taxes?
Absolutely. Again, 409A is just simply a reference to an IRS code section, code 409, paragraph A. And again, that deals with equity compensation primarily. And typically, startups are light on cash. They're building out a team. One way to incentivize early stage employees is to offer them stock options. And when you offer stock options in a private company, very important that you're setting the strike price of those options at fair market value. If you set the strike price at a value that's not considered fair market value, you could have some very negative tax consequences for both the company and the employees, which is a horrible situation to be in. So really important before you issue equity compensation that you have what is called the 409A valuation done, which is where you engage with an expert valuation company to come in, take a look at the numbers, look at the financials, put a fair market value to that private company stock so that when you do issue those options, they are in compliance with that IRS code section and you don't have any negative downstream impact. At a minimum, you should have that valuation done once a year. But if there are any significant changes to your company, bring in a new round of funding, some major milestone is that you may need to have that valuation done a bit sooner.
Awesome. Thank you so much, Anjum. This was amazing information. We do have a question from Olga. She said, can you please clarify once again which form should be filled out by the international contractors?
Yes, so it's form W-8 is typically the form they fill out, but there are many different iterations of that form. So if you go to irs.gov and do a search W-8, you'll get a listing of all the various W-8 forms that are out there. And there's one W-8 for individuals, there's one for business entities, and there's several variations of that form. So the best way to get that right is to chat with a professional that's experienced in that area. But a good start is to go to irs.gov, do a search for W-8, and that's going to pull down a listing of all the various W-8 forms out there, along with instructions for filling them out.
Awesome. All right, well, that concludes, if we don't have any more questions, that concludes our webinar on how to prepare your business for tax season. If you guys have any questions, you can reach out to us at contact@earlygrowth.com. Again, this will be available in the next 24, 48 hours. Look out for an email from us with that link or go to our YouTube page, Early Growth. And once again, don't forget, if you do need to get your taxes done, which I'm sure you do, we are offering $500 off if you sign up by December the 31st. So we hope you guys are encouraged to get on top of your taxes. Thank you so much again, Anjum, for this amazing information, getting it from a chief tax expert. I think someone had something to say. All right, a chief tax expert. So thank you, and everyone have a great day.
My pleasure. Take care, everyone.
Bye.